Hey, Steve Saretsky here. Welcome back to the show. I want to touch this week on a big theme that I think is not getting a lot of attention. You guys know I like to give you sort of my boots on the ground. I have daily conversations with people in various aspects of the industry, and it kind of allows me to put all the pieces together and sort of form like a larger macro framework. And so one of the ones that I think people aren't paying enough attention to is the rental market. So anyone that's well aware is over the last 3-4 years, we've had massive inflation in the rental market, right? So I can speak specifically here to Vancouver. You know, your typical one bedroom in the city core here would rent for about $2,300 a month. Over the last 3-4 years, that's pushed up to about $2,800 a month. You know, a decent one bedroom is about $2,800 a month. That's kind of your market price. And so there's been massive inflation in that. Of course, that's finally, over the last 12 months, finally showed up in the shelter component of the CPI inflation basket. And that's arguably, again, it's been a lagging indicator. It's one that's now sort of giving the Bank of Canada a little bit more pause as to how to sort of proceed. Because like, well, we're still worried about shelter inflation. And again, it's because that rental component is lagging so much, because what we're seeing now on the ground, I talk to property managers all the time. I follow the market. I do my best to study it because it's my job, right? I mean, if I'm selling somebody a one-bedroom condo, I have to speak and say, what can this rent for? Well, hey, maybe it was $2,800 a month. Today, it might be $2,700 a month. And you're like, well, that's like, who cares? That's not much of a big deal. But it's not often. It's not very common in the Vancouver housing market and the other cities such as the GTA, et cetera, where you see rents actually declining. And so I want to put some sort of caveats here. Okay, so turnover rents are still rising, aka, listen, like if you rented a condo in Vancouver 4 years ago prior to the pandemic at $1,900 a month, yeah, like if you get the boot, yes, your new rent's going to be $2,700, $2,800 a month. The churn is obviously still high. But what I'm saying is, if you had a rental unit last year, let's say 12 months ago, you put a tenant in at $2,800 a month, they've just voluntarily left, you now have a vacancy and you need to fill it. What we're seeing is you're putting it back up at $2,800. It's not moving. You're getting very limited showings. You're reducing to $2,750. You're reducing again to $2,700, and you're getting a bid at $2,675. And so that's a significant change in the rental market. And this is predominantly end of cycle dynamics, late cycle dynamics, which is like the rental market is a function of the labor market, right? If you have a booming economy, the labor market's running hot, you're getting rampant wage inflation that passes through into the rental market. You can charge higher rents. There's a demand, right? So like, if you're worried about your job or you just lost your job, you're probably going to leave your expensive one-bedroom condo and you're going to go rent a 2-bedroom, share the cost of the roommate. You might move in back home. You start to change your lifestyle. But when you're feeling good and you're making money and the economy's booming, you go out and you stretch yourself. You get that nicer rental. And so what we're seeing now, again, is the rents are actually coming down. And so I think that has significant impacts, not just on what the Bank of Canada is doing and what's going to happen to the shelter component, 12 months from now. But I think what is important is, what does this do for the typical investor? We already know that the condo market, the resale market, is oversupplied. There's a lot of investors that are realizing the math no longer works when you're renewing at 4.5%, but you're borrowing at 2%. So the math no longer works. And not only that, but your rents now they've peaked out. They peaked out about 12 months ago. And in many cases, they are actually now softening and declining. And so when are you going to start getting rent growth again? It could be 12, 24 months away. And so this is just another wrinkle for the investor, people that, and we saw it firsthand. We saw some of our clients where they put units onto the market and they said, listen, we want to test, this is the price I want. I can't get this price. I'm going to take it off the resale market and rent it out for 12 months. Well, it might not get better. And we might be talking 12 months from now, the price might be the same. It might be slightly lower. Your rents, if that tenant leaves, might actually be lower than what you're getting today. So there's just another wrinkle for the investor. And I think where this predominantly impacts people, again, is in this pre-sale market, because I think that's where the bulk of the issues are happening, is people that speculated. They bought units 3.5, 4 years ago when rates were super low. They might have run their numbers on that, on rates being 1.5 or 2%. And today they're 4.5%, and they're completing. And yes, the rents have grown, but now we're starting to see a scenario where rising rents they're not going to be able to cushion that blow anymore. They're starting to now finally come off a little bit. And so I think, again, that just adds another wrinkle for the pre-sale market. And so, again, any investor or speculator or whatever you want to call them, when they're going out to purchase a pre-sale unit, they're asking themselves several things. Okay, what do I think is the price today that I'm paying? Is that fair? What is the future outlook for price growth? So if I put down a deposit today, do I think this unit's going to be worth more in 3 or 4 years from now? And number 3, what are the rents? And so, again, you might have been penciling $2,800 a couple months ago, but I'm saying you should be penciling $2,700 today. And again, I mean, it's hard to forecast where rent growth will be 3-4 years from now, but I think the numbers in that pro forma need to change. They have to change. The rental market is softening. I think that's, again, a function of the labor market. You look at Canada's unemployment rate, and that's up 1.8 percentage points, 1.8 percentage points from the lows. That's indicative of a recession. Anytime you grow, anytime your unemployment rate ticks up 0.7% from the lows, that's an indication of future recession. That's called the SAM rule. Famous Fed economist, the SAM rule, created that. So 0.7% off the lows. So again, I think for all intents and purposes, the Canadian economy and labor market is in a recession. And so again, that's why you're seeing the rental market now soften. And so this just impacts, again, your investor that's highly levered, or your pre-sale guy that was speculating. They're going to have this it's just not helping the situation. Let's put it that way. It's just not helping their cause. And again, this will all flow through to the new construction side. So we look at the bigger picture and say, okay, we know there's some troubles in the condo market, in the pre-sale market. We can now see signs of the labor market softening and the rental market is softening along with it. When is this condo market going to turn around? And so we have to look at 2 things. I look at the number of units that are currently under construction, so condos under construction in Greater Vancouver, that will be completing over the next 6, 12, 24 months, and we're basically at all-time highs for units under construction. So we know the supply pipeline is full. And we unpack that a little bit further and we say, okay, well, what about the developers? How are the developers doing? Do they have a lot of unsold inventory that they are also trying to move? This is shadow inventory, because keep in mind, pre-sales are not typically on the MLS. They're typically almost always predominantly sold off market. It's called shadow inventory. And so if we look at data from Altus Group, I don't think that this data can be found anywhere else. I'm sharing it here publicly as someone that subscribes to their research and was able to compile the figures. Is you can see that developers are sitting on very high levels of unsold inventory that are, again, they're going to continue to ramp up incentives, which is lowering deposit structures, adding decorating allowances, adding bonuses, reducing prices, because they need to move this inventory. So they will be competing with people in the resale market that are also becoming maybe a little bit more squirmish and saying, okay, I've had this thing on for 3-4 months. I don't really want to hang on to this thing a whole lot longer. I need to reduce. And that's what we've been seeing in this fall market. I talked about it at length a month ago, 6 weeks ago. I said, listen, if you've got product in the summer, people are going to start repositioning. Yes, rates are coming down, but you've got September, you've got October of the busier fall markets. That's your time to strike. If you're a seller and you want to move product, you got September and you got October, because once you get into December, January, and parts of November, the market really slows down rather significantly. So you got September or you got October. Otherwise, you get into basically waiting until February, March to sell next year. So if you want to move it, you got to reposition. That's what we're seeing. People that didn't sell in the summer, you were listed at $799. you're taking it off, you're relisting it, and you're relisting it at $749. And so the competition is starting to heat up. And so this is where I say, bigger picture, macro thesis, I think that the condo market, it's got some challenges. And I think that those challenges are predominantly in the pre-sale investor market, because I think there's more people looking for an exit than there are active buyers today. And again, that demand side could change. It could change 3, 4, 5, 6 months ago. But I think, I don't like predicting markets, but I think the only thing where you can say, hey, listen, I've got some conviction here, is a 2 to 3 month window. I'm very confident in where I feel the market is going. And I think structurally in the next 2 to 3 months, nothing is materially going to change. And so as you get into a new calendar year in March next year, rates will be lower. Could the dynamics be shifting? Could consumer sentiment, which I think is the big driver today, could that start to change? Yeah, maybe. There's a good chance of that. That's too far out that I don't predict that. I think there's a lot of people on here, YouTube, that will put in the comments, and they know where the market's going to be in 2026. They know where prices are going to be in 2027. I'm not naive to suggest that I know where that's going to be. But what I can tell you again is where the market is over the next 2 to 3 months. And I think as we look at what's happening in the rental market, the labor market, and the pre-construction space, I think that the condo market is going to have its challenges. So that's my view. Use it as you will. If you're a seller, use that accordingly. If you're a buyer, use it accordingly. I think there's opportunities in any market, and hopefully do my best here to keep analyzing things and helping people regardless of their scenario, because I get phone calls from people all across Canada and emails asking what to do. And again, I'll do my best to help as much as I can. I'm just one person, don't always get it right, but I'm pretty confident in where things are at today and over the next 2 to 3 months. So as always, hope that helped, and we'll see you next week.